Okay, folks, so we're in the last part of the question that we're going to tackle. In part 5, I'll verbally explain what the logic here is. But in part 4, and this is where it gets a little bit complicated, Ashraf Limited decided on June 30th, 2018 to redeem the outstanding bonds at 102% after paying interest to the bondholders. Show the effects of the transaction on the statement of earnings, which is your income statement, and the statement of cash flows for the year ended June 30th, 2018. Now, cash flows is a concept we'll cover after the midterm, so instead of doing the cash flow part, what we'll do is we'll look at all the journal entries that you would have had to post. So the company uses the indirect method, and again, that's irrelevant when you're preparing the cash flow statement. So let's go ahead and write down what we're going to be doing. So on June 30th, 2018, Ashraf redeemed bonds at 102% after interest. And the after interest is important because you'd have to record the interest if it was being redeemed separately, or you'd have to include the interest in calculating the gain or the loss. So they've simplified this and said this is after interest. Also important to note is that the date they're redeeming the bonds is June 30th, 2018, which is exactly 1 year after they issued the bonds on June 30th, 2017. So if we go all the way up to the top, we know at June 30th is when they issued the bonds originally. So when you're in a situation where you're looking at gains and losses on redemption of bonds, first thing you need to make note of is what amount did the bonds get redeemed for, or what was the cash that was paid by the business to redeem the bonds. Okay, so in this case, we'll say cash paid to redeem bonds, and it says 102%. So 102% off the original face amount, because from an external perspective, the people that have bought your bonds will know that the face amount is what they were going to get back at the end. So when you're buying out a bond early, you have to look at the face amount and work off of that. So if this number is over 100% or under 100%, you always start with the face amount. So we know our face amount is $4 million and times 102%. So 4080 is the amount that was paid by Ashraf to redeem 100% of the bonds. Once you've calculated how much you paid for the bonds, next thing you need to do is figure out what the book value or the net book value or the carrying value, whatever you want to call it, of the bonds is. All right, so we'll just say carrying value of bonds. And this concept is very, very similar to when we were looking at long-term assets. When you sell an asset, you need to see what the value of the asset is after amortization. So you know from when you did part 1 of the question, and we're going to scroll all the way to the top, part 1 of the question, we calculated the original price of the bond as 422.9374. Right? So this was the original amount we calculated. Then in parts 2 and 3, we know that we amortized the premium portion of these bonds 2 times. So the first time, amortization, can't spell here, so let's try that again, amortization of premium. So amortization of premium, the first time we did it in part 2 was 3119. And we're going to take the same amount for the second part using the question as it's laid out. So let's ignore the semi-annual example I was showing you earlier. Let's look at the annual version. The second time the premium was amortized at 3119 as well. So 2 times reduced by 3119. So we know the net book value of our bond is 4223136. right? And we'll go quickly to the solution. It's 4223136 right here. So we know we're on the right track. So let's get back here. So that's our book value. Book value. Okay. So we know when you're trying to calculate gain or loss, you simply take the amount of your book value and deduct that from the price. So now in this case, we are buying back our bonds. So our bonds to us are worth 4.2 million as a liability, but we're only paying less than that at just a little under 4.1 million for our bonds. So since we have to pay less for liability, in this case, you're recognizing a gain. So the gain amount is 143,136. All right, so in this case, we know it's a gain. So there we go. That's our gain. Now, the way we're going to present this is we're going to keep an eye on not the cash flow part because that isn't relevant just yet to you. We're going to focus on the journal entries that you would post. So in this case, you know when you retire your bonds or when you pay them off at the end or you're early retiring your bonds like the example here, the first thing you need to get rid of is your bonds payable. And you would get rid of the original face amount of the bond so that you can zero out that account. So since it was a credit account, we're going to debit it. So that's $4 million. The second thing you want to do is you know the cash that was paid for the bond, right, to retire the bonds. And that was the 4080 up top from here. This 4080. So you know that's a credit to cash. So these two amounts are very easy, the 4 million and the 4080. Where it gets complicated is you know that you need to clear out your amortization, or you need to remove the premium that you had. So amortization of premium. And a little trick here that you can do is instead of trying to calculate this amount up front, what you can do is you can back into the amount by first saying you know your credit other than for cash is also going to be for this gain, right? So you're going to say gain on bond redemption, and you know your gain is 143,136. So the difference between these amounts right here is 223,136. And if you add that up, now you know you get to 0. And you know your entry is balanced. So rather than trying to calculate this from scratch, and you absolutely could do that because you know that your book value is 4223136. Your face value is 4 million. If you deduct the two, you're going to get 223,136. It's not always that simple. So if you're showing the working for how you calculated the gain, you know your gain is going to be a credit because this is income statement and gains are a credit on the income statement. You know this is a liability. You know this is a liability. And you know cash is an asset. So these amounts would go to the balance sheet. This amount right here would go to your income statement. So the question asked you to show what that would look like on the income statement, and you'd simply show that as a other gain or part of your income, just like the way they did it in the solution. Now part 5 of this question asks you, why would Ashraf engage in an early redemption of his bonds? And generally there could be a number of factors. The easiest one is if there's a change in the interest rates in the market. So let's say the market interest rate declines so significantly. So let's say when you issue your bond in it, up front, the market interest rate here was at 6%. And let's say there's some kind of recession, and this the market rate has gone from 6 to 4. And Ashraf knows this, so what they could do is they entice the bondholders and say, hey, we will pay you an extra 2% if you want to cash out your bonds right now. And what they'll do is they'll take the money, or they'll pay the extra money up front so that they can issue new bonds at a lower interest rate. That could be one reason. Now, there's a number of reasons. I'd encourage you to look at the solution and see what else is in the textbook for examples of why bonds might be early redeemed. So that's that for that question. It covers all the significant aspects of non-current liabilities, particularly bonds. The next video we'll look at will be on case writing, and that'll be in a couple parts on the main parts of case writing and supplementary aspects. So stay tuned for that one.